Google is one of the best stocks out there. It has a great balance sheet, great cash flow, great business with high margin. But like the rest of the tech world, it has really fallen a lot lately. So what you need to find out is, has it fallen enough to get in the wheelhouse to give you outside returns versus the market? So we're going to use our 8 pillars to sit there and evaluate Google and decide what to pay for it today based on today's numbers and the future assumptions. So if you have our software, please follow along. So let's go to Google. We're typing in Google here, the Goog. All right, so first things first. It hit a high of 151 in the last 1 year and a low of 101. It's currently at 110. So I like to look at companies that are hitting new 52-week lows. Why is that? Well, I like things that are cheaper. Now, does that mean it's a good buy? Not necessarily. If it's 10 times overpriced, going down 33% isn't going to make a lick of difference. So let's go with our 8 pillars. Pillar number 1, very simple. We want the 5-year PE ratio to be under 22.5. So we scroll down just a smidge. 33.42 is our 5-year PE. So that's an X to start. Not a big deal because Google has been a very fast-growing business. So if that goes forward, you can afford to pay a higher price for more growth. Pillar number 2, we want the 5-year return on invested capital greater than 9%. So just here to the right, we see the 5-year return on invested capital of 13.9%. This is wonderful. This means that Google can reinvest the capital back into the business at high rates of return. That can also justify a much higher PE. So we're on the right path. Now, as you notice, Google pays 0 dividends. They pay 0 dividends probably because they think they can invest the money at higher rates of return. Pillar number 3, very simple. We want revenue growth over the last 5 years. I don't care if it's $1. I just want to see some sort of revenue growth. So we go to our income statement and we scroll down just a smidge. 5 years ago, they did $103 billion in revenue. Actually, I lied. 5 years ago, they did $130 billion in revenue. And last year, they did $278 billion. Over double in the last 5 years. That is 15% revenue growth over the last 5 years for an already ginormous company. Pillar number 4, simple. We want net income growth over the last 5 years. So we scroll down just a smidge, and 5 years ago, they made $16.3 billion, and last year, $72 billion. Now, this is an increase of almost 5 times the profit on an increase of revenue of double. How did that happen? Well, let's go back to our main page, and I'll show you. Right here, this massive gross margin. 57%, along with a high bottom line margin. And this bottom line profit margin is after taxes. So it shows that their overhead costs are a lot lower. So every extra dollar they have in profit can really build on itself. That's how a company goes from doubling revenue to increasing its profit by 5 times. These are the compounders of the world. This already tells me I should be willing to pay a higher price and a higher PE for Google. Okay, pillar number 5. Pillar number 5 is the silent killer for investments. So what does that mean? When a company wants to raise capital, they can do it in one of 2 ways: debt or equity. The way a company would raise equity is by issuing shares. The downside to that is it dilutes the investors that are already in the business. So if you own the stock 5 years ago and the company raised money by issuing shares, what they've done is they've diluted you. You still own the same number of shares, but now the revenue and the profit within the business is now being split up amongst more owners. And this dilutes you as an owner. So in order to see what's happened here, let's go to our income statement, scroll all the way down. At the very bottom, we want to go to the end of year 6. They had 13.84 billion shares outstanding. And today they have 13.13. So that's a check mark. This means they are not diluting the owners in the business. So we like that. Now, I won't say anything about is it's right or wrong based on the valuation of the business right now, but we prefer companies that are less expensive, that are selling at a value to be buying back shares. Pillar number 6 has to do with long-term debt. Debt works for an individual the same way it works for a company. So for a company, companies with more debt are going to have more problems if problems occur. Right? Very obvious. As a person, if you have $0 of debt, versus 10 million of debt, you're more likely to have financial issues if you have 10 million in debt versus 0. So let's go find out what's a reasonable amount of debt for Google. What I've done is I've decided to look at their 5-year average free cash flow right here on our main page at $40.8 billion a year over the last 5 years. I take that number and I multiply it by 5. So to make it easy, we'll call it $200 billion. What I want is the long-term liabilities of Google to be under $200 billion. So where do I find that? I go to the balance sheet. So I scroll up here to the top, go to the balance sheet, and then scroll all the way to the bottom. And right here, total long-term liabilities, $38.4 billion. They can pay off their entire long-term liabilities with less than 1 year of their last 5 years of free cash flow. That is incredible. These are the things you want to see from companies that will stand the test of time and stand recessions and down markets. Pillars 7 and 8 have to do with free cash flow. If you've watched this channel before, you know how much I love free cash flow. It literally makes me cry from excitement. It's the best thing that ever happened to companies. And I love companies that I can buy at lower multiples of free cash flow. So if you're new to this channel, I'm Paul. I'm a value investor. What that means is I use my 8-pillar portfolio approach here to sit there and weed out companies based on their quantitative aspects. If something hits my criteria, I then go approach the company from its qualitative aspects, the things that cannot be counted. And from there, I want to find situations where price and value are disconnected. I want to buy where the price is well below the value. How does that happen? The same way it happens when markets are going up, the same thing happens when markets are going down. People overreact. We all overreact to everything that happens in our life. The same thing happens with companies. No company is overpriced forever, and no company is underpriced forever. Eventually, things come to the market over the long run is a weighing machine. In the short run, it is a voting machine. So if you like this, keep watching on, keep watching our videos, and don't forget to subscribe to our channel. So pillars 7 and 8 are free cash flow. So let's go to our cash flow statement right here. And free cash flow is cash from operations less your capital expenditures, okay? You can do one of 5 things with free cash flow. You can buy back shares, you can pay a dividend, you can pay down debt, the very little debt that Google has, they can pay down. They can reinvest back in themselves, or they can make acquisitions. Any combination, whatever they want to do, they can do one of those 5 things with free cash flow. So going to our financial statement. We have cash from operations, less your capital expenditures, and your Uncle Paul has put a nice little line in here that nobody else gives you, which does the free cash flow number for you. So 5 years ago, $21 billion in free cash flow. Last year, $65 billion in free cash flow. Triple the number. So remember, revenue was up double, profit was up almost 5 times, and their free cash flow was up triple. That's an incredibly effective business at generating more and more profit as time goes on. Our final metric, pillar number 8. We want to take their 5-year average free cash flow. We want to multiply it by 22.5. Why do we do that? Well, if you remember at the beginning, the first pillar is the 5-year PE being less than 22.5. So all we're doing is working backwards to a market cap that would fit the exact same thing, but based on the free cash flow because of how much I love free cash flow. So 40 billion times 22.5 equals $900 billion. So we want the market cap of the business to be under $900 billion. If we can do that, then this is looking like a screaming deal for us to do more research on. So we go back to our main page and we look at our market cap. $1.45 trillion. Now, before you get depressed and turn off the video and go cry, just remember, a fast-growing company with a high moat should sell at a higher price. So you have to ask yourself, well, what's a reasonable price to pay? Well, that's why we have the stock analyzer tool. This is exactly created for us to put in the assumptions about the future because we don't know what the future holds. All we can do is make assumptions and then use our stock analyzer tool to tell us what to pay for the company today in order to make it a good investment. So let's go check out what the analysts are saying first. So we have our analyst estimates tab. Right now, our data feed provides us with 55 analysts' expectations over the next 5 years. Now remember, There aren't only 55 people in this world that are analyzing Google, right? There are way more, but this is our data feed right here. The first levels are earnings per share. So right now on the 55 analysts, $5.26 a share up to $9. So almost double in the next 5 years, which is pretty substantial, but it's not what we saw in the past. What about revenue? Go down here a little bit further. Revenue from 300 billion to 460, a 50% increase roughly. Now guys, look at the percentages here. Low double digits, low double digits. As you can tell, Google has slowed down. Is that a bad thing? No. It's exactly what's expected from very, very large companies. Just think about it. Is it more likely that $1 million company doubles or a $100 billion company doubles? It's obviously much easier for a smaller company. You're going to sacrifice some growth, but to get stability. So now we input some assumptions into our stock analyzer tool. Guys, this is super, super important. What I want you to do is make sure you rewatch this part of this video as much as you can. I'm going to explain it in a little bit more detail than other videos because we have the time here to look at it. But before we get into it, I want to talk about the bull and bear cases for Google. Remember, every company has amazing potential and every company has bad news. There's no possible way that a company like Google can have everything be rosy and everything here be bad. Here are 3 bear arguments to Google. 1, foreign exchange rate. The US dollar is crushing foreign exchanges, which can hurt Google because Google gets a large and growing percentage of their revenue from foreign countries. If this continues, which by the way, my personal opinion is it will not continue, but if it does continue, that could hurt Google. 2, government regulation. You know the government, they hate a successful company and they're going to sit there and say, wait a second, Google, you're dominating the advertising market. We're going to stop. That is a very real possibility. Is it going to happen? I don't know, but that is a possibility for the future that would impair their largest revenue generating aspect. Bear case number 3, growth. The company has grown a ton. The entire industry is expected to grow almost 16% a year. But Google is going to have 25% lower than that, around 12% or so. That is a hindrance. Again, you heard me talk about it before. That's not as big a deal for me. However, for those people out there who think the future is everything and it's huge and bright, and they don't like seeing falls in growth, that's going to hurt them. I love it. I prefer that. That way people are more negative about the business. So what are the bull cases on Google? First bull case. The inflationary market that we're currently in is already starting to see some hold down. We've seen 2 months in a row of basically flat pricing. That is helping the foreign exchange rate because with the inflation overseas being so high, it made our currency a lot stronger and therefore hurt the currency exchange rate. Number 2, Google's doing a great job in their cloud computing business like AWS and Microsoft, as well as in their other ventures to get more revenue. So they're trying to work on much more revenue streams. This very channel you're watching right now is owned by Google, and it's still growing. Is it growing as fast as it was 10 years ago? Of course not, but it's still growing tremendously. And number 3, even with all those issues above, I personally believe that people are over-dramatizing the possible scenarios with Google. Does that mean to buy it today? Again, we'll get into that with the stock analyzer tool. But remember, people overreact on the upside and the downside. Use that downside overreaction to your benefit. So let's go to the stock analyzer tool. Now, guys, first things first, is Google going to be around for a long time? My guess is yes. So I'm starting with a 10-year analysis. And in our software, you can do 1 to 20-year analysis. First line, revenue growth. Now, even though we have the 1, 5, and 10-year revenue growth numbers north of 20%, remember what analysts were doing. They were doing low double digit for the next 5 years. So to go even further, my guess is 9 or 10% is probably the higher range of the revenue growth. So on the low side, I'm going to do 4, middle 7, high side 10. Now for profit margin, I still think profit margin should be very strong. Maybe even get stronger as they do more cloud computing. As you can see, their profit margin's actually up over the last 1, 5, and 10 years. So 10 years, it was 22.7, 23.2 for the last 5 years, and 25.9 for the last year. So there's a lot of stable profit margin. So I'm going to sit here and keep this number pretty close to where it's been. I'm going to do 22, 23.5, and 25%. And guys, if you've watched this channel before, free cash flow and profit margin should be very, very close. So I'm putting the exact same numbers in here. Now, finally, PE and price of free cash flow. Guys, this is the PE and price of free cash flow you should expect for the company 10 years down the road, not today. So after they've already grown a lot more, you should pay a premium based on growth level and moat and high ROIC. I do think the moat will be even bigger 10 years from now. Google just dominates the search and advertising business. So unless the government comes in and really puts a hamper down on that, I don't see that changing probably anytime soon. But could it? Sure. But in terms of growth, guys, it's going to be doing $250 to $300 billion in revenue in 10 years. Actually, more than that, I'm sorry, $500 billion. So at that point, you got to assume that the growth level is not there. So if the average PE for companies is 15, I'm going to do 13, 15, and 17. I will acknowledge one thing that I want you to hear from me. I think 13 is too low for this company. But again, my goal is to be conservative. I want to find the 10,000 stocks out there and find 20 to 40 that if I assume very conservative numbers, I can do very well with them. Your goal as a value investor should be to be very conservative. There are 10,000 stocks out there in this world for you to choose from. Your goal should be to find 20 to 40. So the more conservative you are, you will still find the 20 to 40 stocks that still fit your criteria, and you should be able to buy and get outside returns. Now, finally, desired annual return. Guys, you can invest in an ETF and get 9 or 10% over a long period of time. So if you're going to buy an individual stock, you need to give yourself some margin of safety. So what does that mean? Well, on the low side, I like to do 12.5%. That's enough for a low side margin of safety. And I've already been pretty conservative here on these assumptions. So it's more likely these are going to occur. As I go higher in my assumptions, I want to increase my desired return because that drives down the price of the stock. The more return I want to make, I have to pay less for it today, correct? So here, as I get higher assumptions that are unknown, I want a higher return. So I'm going to do 15 on the next level and 17.5 on the level after that. So this is my way of giving myself more margin of safety as I make my assumptions higher and higher. So I'm going to hit the analyze button. What's going to happen? When I hit the analyze button, I'm going to get 6 numbers. 3 low, middle, and high of earnings, and 3 low, middle, and high of free cash flow. If it's all green, you're thinking to yourself, great, let me go buy. Hang on a second. It's now your time then to go research and make sure this is all accurate. How do you do that? It's called Scuttlebutt, guys. Go out there. Go read analysts' opinions. Go out there and read other people's opinions that are just regular investors. Or better yet, join this community. This is our community of investors. There are thousands and thousands of active investors in there, and I guarantee you they're looking at Google. Why? High cash flow, low debt businesses. These are the kind of businesses that value investors absolutely love to buy. So go in there, have the conversation, look up Google. It'll take you right to the chat where this is being done. This is less than a cup of coffee per day, guys. You get all the software and the chat and everything on your mobile phone, all for less than a cup of coffee per day. Everythingmoney.com. Go check it out. Or if you're international, patreon.com/everythingmoney. So I hit the analyze button. Boom. All right, guys, we have a low price of 55, a high price of 78, mid price of 65. And that kind of makes sense due to the fact that I was pretty conservative on my revenue growth numbers and margin. So if you're interested in this company, what I recommend doing is add it to your watch list. Click right here on any of the numbers, add it to your watch list, 78.14. I'm going to call it 80. Notify me. It'll notify me via email and on the phone and the app. And when it hits that price, I can go do more research and get ready to buy it at the price I want to buy it. To better understand this process, you need to go watch the next video on margin of safety. Thanks very much for your time.